Okay, so good evening, everyone. So thank you for joining our webinars today. So hope everyone of you are doing well. So my name is Sherry for Phillip Capital Marketings, and I will be the MC for today. So during the webinars, if you have any questions, to type them into the question box, and I will address the question during the Q&A section at the end of the webinars. So before we introduce our speakers, please allow me to introduce our companies. So as usual, I need to emphasize on our disclaimer where this presentation has not been reviewed by Securities Commission Malaysia and is provided to you solely for general information and does not constitute any recommendations. We are not liable for any losses arising based on the information. So investments are subject to investment rates. Therefore, you shall seek advice from quality advisory before making any investment decisions. So first, Phillip is the wholly owned subsidiary of Phillip Capital Holding Sdn Berhad, and it is incorporated on 7 October 1995. So our headquarters is in KL, and branches distribute across Malaysia such as Kota Damansara, Melaka, Penang, Johor, Kuching, Cebu, and Kota Kinabalu. Other than that, Phillip Futures is a trading participant of Bursa Malaysia Derivative Berhad, carrying participants of Bursa Malaysia Derivative Clearing Berhad and also a holder of Capital Market License, which is known as CMSRL. Next, I will take this opportunity to extend our gratitude on behalf of my company, which is Phillip Capitals, to our clients. So without you, we are unable to achieve the rewards. So in 2020, we achieved 3 rewards from Bursa Malaysia, which is the best overall, the best retail, and the best institutional derivative trading participants. So other than that, our mother company, Phillip Capitals, has office and branches over 15 different countries. So for futures, we not only cover products in Malaysia, we also cover different exchange such as Singapore Exchange, CME, CBOT, NYMEX, and more. So with our strength of global coverage, clients are able to trade both local and foreign products under the same platforms. So next is the product which is available in Phillip Capitals. So actually we are offering futures, contract for difference, and equities. Okay, so next, why would you choose Phillip? So first of all, we provide advisory service such as inquiries. Next, we also provide wide variety of products for futures to enable clients to trade both and local products. Other than that, we also will send out the latest market news and commentaries to clients every day through email for reference. Lastly, our headquarters have 24 hours brokering and execution support. So this is important for your client to trade foreign futures, and also dealers can assist your inquiries every time. Other than that, so no matter you are our client or not, we will offer one-to-one coaching sessions, free seminars and webinars, and for free account openings. So next, for free one-to-one coaching sessions, the key topic that we are focusing are introduction to futures trading, product knowledge, platform coaching, and charting system. We also will conduct the free seminars and webinars regularly, so you guys can scan the QR code to register for more upcoming events to gain more knowledge. So there's an introduction for regarding our company. So today, I would like to introduce our speaker, which is Jun Hang. He's a CMSRL holder in securities and derivatives. So next, I will pass my slide to him. Okay, so Jun Hang.
Hello. Can you hear me, right?
Okay, yes.
Yeah, okay. Hi, good evening, everyone. So welcome to the webinar of Unveiling the Future, Introduction to Futures Contract. So first of all, I'm Jun Hang, dealer from Phillip Capital Melaka branch. So thank you all for joining us for tonight's event. So I will just move on straight to the agenda today. So basically you see from here, we have 5 agenda for today. So I will move quick to the first one. Okay, so yeah. Okay, so what is futures trading and how it works to you guys? Okay, so move on to next. Okay, you can see from here. So futures contract is a legal agreement to buy or sell a particular commodity asset or financial instrument at a specific date for a stated price in the future. What does this mean? Okay, so you can understand it's a legal agreement between buyer and seller to buy or sell a particular commodity asset or indexes at a specific price and time. So basically, this the commodity asset you can understand as oil, gold, or bonds. Okay, so futures contract and futures refer is to the same thing actually. For example, you might hear someone say that they bought futures, which means the same thing as an oil futures contract. When someone says futures contract, they are typically referring to a specific type of future, such as gold, oil, and bonds, or S&P 500 index futures. So basically, futures contract are one of the most direct way for you to invest in oil and also gold and indexes lah. So the term futures is slightly more general. So when you hear people say futures, yeah, so it's often used to refer to the whole market lah. You can understand that they are futures trader. Okay, so yeah, futures contract are also standardized agreement that typically trade or exchange. So basically, you can understand the standardized are on the quality and quantity to facilitate the trading on the futures exchange. Okay, moving forward. So these are the futures contract product, future product that we are providing lah. So basically, this agriculture futures. So we have crude palm oil, the one that Malaysia produce a lot of it. Crude palm oil, wheat, corn. We can trade corn as well. You can trade coffee as well. And index future, our very own FKLI, which you can know as KLCI, Hang Seng Index, Dow Jones, China A50, and for metal futures, the well-known gold, silver, and copper, and also energy futures, just so you know, crude oil, natural gas, and gasoline, and of course, interest rate futures. Yeah, we can actually trade interest rate also. So we have KL Interbank Offered Rate, US Treasury Note, and US yield futures. So move on to the next one. So basically for futures contract, they have these 4 elements. So the first one, asset class. So you can understand the asset class as the underlying instrument for the contract. So for example, agriculture commodity, the asset class underlying instrument is crude palm oil. And precious metals and energy product are oil and natural gas. And the next element, so we have quantity. So the quantity you can understand as the size of the contract, which is typically outlines the specific number of the unit bought. For example, one contract in WTI crude oil futures, you will have 1,000 barrels of oil. And for gold trading, one contract will give the market player to buy 100 troy ounces of gold. Basically, is the calculation for gold lah. Okay, so and for futures contract, we do have expiration date. So all futures contract must have end date. The expiry date is on the final date of the contract can be traded. So basically, after the date, the contract must be settled under the terms of the agreement lah. And for price as well, so the price of the contract is determined by the open market. So it will be reflecting on the value of the asset itself. So futures contract will contain a specific price, is usually tied to the spot price or cash price of the underlying commodity. Okay, so I hope I'm not too fast. Okay, so the next one is, okay, so in futures, we do have the 2 settlement. So so normally we close out before the expiration date for the settlement. So it's important to know the contract delivery term. So there are 2 types of settlement in futures market. So the first one, which is more often used, is the physical delivery. You can understand as physical settlement, which are more often seen in gold, soybean, crude palm oil. While other instruments like contract based on S&P futures and index are all settled in cash. So you can understand that settled in cash lah. Okay, moving forward. Okay, why do people trade futures? What are the advantage that why let a lot of people really trade futures? So One of it is leverage. I will give you a brief explanation after this. High liquidity, bi-directional trading, and low transaction cost. These are the four main advantage why people trade futures. Okay, so from here, you can understand as what is leverage. So basically leverage is you use smaller capital upfront to trade greater value of contract, meaning you are using lesser money to trade a higher value contract. So normally it's 5 to 20% of the full contract value. So you can see from futures market, actually the initial margin to trade our crude palm oil is only 7,000. And for cash market, the current price is actually for now our crude palm oil price is priced at 3,878. So you can understand the market price as of today. So I just gotten this in this evening. So the price now is 3,000 plus. So how to calculate the contract size and the total cash market value. So basically you take the contract value, you times by 25 ringgit. So why is that 25 ringgit? Because it's the minimum price fluctuation. So basically this cash market, if you were to invest is in cash market, you will need 96,950. But in futures market, you only need initial margin of 7,000. Then you can start trade FCPO, which is our crude palm oil. Yeah. Okay. Moving forward, I'll give you an example on how do you actually trade inside the market. Okay. So for FCPO, we call it crude palm oil actually. So we do trade crude palm oil here. So basically, as I show you the A, right? A is the cash market. Cash market is the contract value, as I told you just now, 96,950. So how do we actually see the market? So you assume that today you buy you enter the market with a buy. We can call it long as well. So you long at 3,750. So assume that market go your way, like market increase. So market increase for 150 point. So the minimum price fluctuation is 25 ringgit. So from here, 150 point times by 25, you are getting this amount of profit by going up 150 point. So from cash market, actually your return on investment is slightly lower because you are using 96,000 plus to gain a return of 3.8%. Only 3,000 plus because you are investing a lot, right? But in futures market, when you are only using initial margin of 7,000, but you get the chances to trade in a lower price, but the return is the same. So it's the same 3,700, 5,850. So you can see the percentage you are getting back. So basically what I want to tell you is that cash market requires you a lot of money to trade in futures market, but futures market you can trade it with initial margin of 7,000. Yeah, so you can see the two comparison. Okay, so moving on. So you can see from here, so the number of volume traded, so from our very own Nova platform. So high liquidity is actually an advantage as is allowed for quicker transaction. So you can see the price for bid and ask is actually you enter long and short, because I will bring up next, because futures is bi-direction market. So basically you can buy or sell the futures contract. So you can basically the spread won't be far away. The moment you sell, you will sell directly for the market best price. So the ability to quickly buy or sell a particular asset without causing so basically you see from here, if you buy today, so the next time when you were to sell, the price wasn't far away. So you can understand as that. So this is the high liquidity advantage. So sometimes you have other contract that the bid and ask price are quite far. So when you were to sell, but it wasn't the best price you wanted. So these are the good thing about futures contract. And next is the bi-directional trading. So In futures market, you can do both long and short, okay, which you can understand as buy and sell. Unlike the stock market, the majority local stock market only can long. If your market prediction expect the index or the commodity to decrease in coming days or week, you can place a short order when the contract decrease, you will gain profit from there. I think it's slightly more understand for this because you can do two-way instead of one-way. Yeah, okay. So moving forward, moving on to the low transaction cost. So basically, futures market and the cash market, this is just a very easy comparison because why is that 73,000? Because our FKLI market, this is the price for current price as of 1st December. So the cash market is times by 50 because the minimum price fluctuation is 50 ringgit per point. So you can understand cash market, we will need 73,000 to invest in for FKLI. So basically, these are the transaction costs for cash market. You will need to pay brokerage fee of 5%, stamp duty of 1 ringgit for every 1,000. So basically, it's 73 ringgit, and clearing fee of 3%, 0.03%. Okay, so you can see because it's two-way, right? You enter and you have to exit. So if you were to enter cash market, so basically it's 919.80 cents for per entry. But for futures market, you only need 4,000 for FKLI. So the rest you just have to pay brokerage fee, 15 ringgit. In and out 30. So these are the two transaction costs you can compare. So it's really far away. One is just 30 ringgit and another one is 900 plus. So you can see for yourself. Okay, I will move to the next one. Okay, I'll just briefly introduce you our famous FKLI. You can understand as KLCI, Kuala Lumpur Composite Index, and also our FCPO, crude palm oil, and the key fundamentals that drive the futures market. So, okay, so for FKLI contract specification, so the underlying asset for our FKLI is as I told you, is Kuala Lumpur Composite Index. And the contract size has to multiply the current value of FKLI, the current price. So the current price now for 1st December, yeah, is 1,460. So it has to time by 50. So the total value of the contract is 73,000, as I showed just now. And the minimum price fluctuation is 0.5 index point value as 25. So how do you understand this? So assume that market price today is 1,460. So when price go into your favor, let's say increase by 1 point. So you are holding a buy position, or you can understand as long. So you are earning a 50 ringgit from there because it's 1 point. 1 point is equivalent to 50 because 0.5 is 25. If price drop to 1,459.5, which means 0.5, so you lose 25 from there. And you can understand that FKLI is settled by cash because it's indexes. Okay, so the final trading day for FKLI is the last business day of the contract month. So assuming that this month is January, so the last trading day will be the last business day of January. So it's basically that. So trading hours for FKLI is every week from Monday to Friday. For first and second session, the first session is 8:45 until 12:45. For second session, start at 2:30 to 5:15. And for this T+1 session, right, is actually start from 9 to 2:30. So basically, if the first session for Tuesday is 9 to 2:30, so Monday to Thursday. For Friday, the last trading time will be 5:15. So this is the trading hours. Okay, so actually, what is KLCI for you guys is that it represents the top 30 companies by market capitalization on the Bursa Malaysia main market. So basically, you can understand those big names in Malaysia like Public Bank, CIMB Bank, like TMB. So basically, most of them are in the FKLI. So basically, they are the front of Malaysia economy. So this is what you are trading on. Okay, so factors that will affect the FKLI market. Okay, the first one is the interest rate. So basically, if interest rate rise, the interest index futures will decrease. Interest rate influence the market in two main ways. So first, any changes in interest rate will affect the discount rate used in most of the modern valuation technique. So basically, you can understand is really important for the valuation, basically on the property or whatever. Following that, the cost of borrowing, which is turn affecting the anticipated cash flow of a firm. You can understand as they can affect the cash flow of the company involved in FKLI. Okay, so basically when interest rate, when they cut or when they even they increase, it will affect the FKLI market as well. Okay, oil price. So oil acts as a major input for most of the industry, so especially in production. So increase in oil price will induce unemployment, cause boost inflation and uncertainty. Furthermore, the rise in production costs as the result of oil price hike force firms to cut down on their production capacity. So you can understand that when the price of the oil goes up, it can really affect the FKLI market. I mean, not just FKLI, I think the whole country will be affected because we are using oil daily, like in terms of transportation or even production. So it's all affected. Okay. So another thing that happened unusual is that in 3 years back then we have this COVID-19 pandemic. So basically, I will show you the graph later. So basically, our FKLI dropped to 1,300 points to a 10-year low. You can understand that it dropped really drastically down because it's something that people can't predict. So when everything closed out, it's really affect the company or even the Malaysia economy. I think even globally are affected. So basically, these are the things that we can't predict. And of course, political uncertainty, the handling power between prime minister. So in Malaysia, we always face a situation where we suddenly, I think in the past few years, we faced the situation whereby we suddenly we change prime minister, or maybe not the prime minister, maybe they come up with a new system or a new rules. It can affect some of the established company. You can imagine if you are an investor from the foreign country, it will also affect the index as well. Okay, so the last one is the exchange rate. So currency impacted for imports and export. So the volatility of in the exchange rate has direct impact to the firm competitiveness and profitability, where exporters are expected to benefit from the depreciation of the local currency and vice versa for importer lah. So basically, you can understand when the exchange rate are good, it's good for the exporter to get a good price from the depreciation. So it's a vice versa thing lah. So basically, exchange rate do really affect the FKLI market. So moving on, okay, sorry, you can see from here. So maybe this thing is not new for you because we all have passed this pandemic. So you can see from here, FKLI market index during pandemic. So you can see from this, sorry. Okay, you see from here, Monday, 16 March. So our Prime Minister announced we will have MCO after the spike in COVID-19 case. So basically, 16 March 2020. So you see when he announced the MCO. So what happened to our FKLI? So it's supposed to be 1,500 the price, but it dropped until I would say 1,150. So you can see if this time you are short, you are entry with a short market, you can imagine how much you earn from here. So basically 1,500 minus 1,200 is 200 point. So 200 point times by 50, how much you are earning from there? Yeah, it's approximately 10K just by trading on this. But we don't actually face this every time. Just that it's an opportunity when we have bi-directional market, because you can if the market is not that good, you can place a short in the market lah. That's what I want to share with you. Okay, next. Okay, moving on to the crude palm oil. So basically, the FCPO are the underlying instrument of the FCPO is the crude palm oil. So just for information, Malaysia are one of the top 3 exporter for crude palm oil, and the contract size for the FCPO is 25 metric ton. So how do you calculate the contract value? Is based on the current price of crude palm oil. You have to times by 25 metric ton. So basically 96,950 is the contract value for FCPO. So the minimum price fluctuation is 1 ringgit per metric ton. So if the market price is 3,878, so when the price goes to 3,879, so goes up by 1 point. So when you are in long position, and you can understand as buy position, so you are earning 25 ringgit from here. So for vice versa, like if you were short, so if market drop by 1 point, you are earning another 25. Okay, for settlement for FCPO is slightly different to FKLI, is that they are on physical delivery, because they are physical product on crude palm oil. Yeah, and final trading days for FCPO is that the contract expires at the noon of the 15th day of the delivery month. So basically, for current, our contract is 3 months later. So it's assume that today is 15, so it's the last day of the after 3 months lah, you can say that. But this I think you need to understand more on this after this, yeah, because it's take some time to understand also. And for the trading hours for Malaysian time is that it's almost not far away from FKLI, just that the T+1 session is almost the same, the understanding. For first session is 10:30 to 12:30, and for second session is 2:30 to 6, and the T+1 is from 9 to 11:30. The last day of the week is until 6th of Friday. So basically this is the trading hours. Okay, so the factors that will affect the FCPO market is that, okay, so one of the most famous is weather season. I'm not sure you guys aware that actually the weather issue can actually affect our palm oil production. So we have this weather season of La Nina and El Nino that will occur every 3 to 5 years. Basically, it's warmer than normal temperature on the Pacific Sea for El Nino. So basically, El Nino you can see from the photo here. So El Nino is usually on the warmer side, and the cooler than normal temperature on the Pacific Sea is for La Nina. So for your information, this can also bring to Malaysia as well, because our palm oil tree requires warm weather with humidity environment to produce actually. So these are the things that will affect our FCPO market as well. So okay, moving on. The volume of, you can see from here, so we are one of the top 3 producer country. We have from Indonesia, our neighbor country, and also Thailand. So the export tax will also affect the price as well. And for the top 3 consumer countries, we have from India, European Union, and of course China. So the volume of import and export can directly affect the palm oil prices, mainly due to the import and export taxes charged by each nation. So you can understand, like when you were to export, you have tax from the government. Even import, you also have tax from the other nation government. And also the production rate on the palm oil will determine the price also. So moving forward to the next one is the supply and demand. I think this is the most simple understanding on how it actually affect the FCPO market is the supply and demand. So when the production is limited, price will increase. When the production is a lot, price will decrease. I think it's very easy to understand for this. And for festival season, so like Deepavali and Chinese New Year, people from India, China, they will tend to purchase the oil for their prayers. So the demand on the festival season itself will affect the palm oil prices because there's a lot of demand. So when there's a lot of demand, it will affect the FCPO prices also. Okay. So far, do you guys is it okay for you guys? Are you guys still understand, still into it? Okay, let me move forward. Okay, just give me 1 second. Okay, so in futures, we do have this thing called margin call. Okay, what does margin call do? Okay, so okay, you can read it from here. So margin call happen when traders do not have enough account balance to hold position overnight. So I'll give you the easier example. So the initial margin for FCPO is 7,000. So the maintenance margin you can understand is 100%, basically is 7,000. So if the current equity balance is at 6,000, will trader have margin call, and why? So basically you see from here equity. So assuming that you only have 6,000 in your account, but the initial margin for FCPO is 7,000. Sorry, only 7,000. So from this case, you will be receiving a margin call from broker house. Why is that? I'll give you the example. Okay, so for day one, assuming that you long one contract of FCPO around 4,000, you can understand the current price is at 4,000. So basically, the market don't go your way. The market dropped by 40 points. So 40 points times by 25, which is the minimum price fluctuation. So 40 points times by 25 is 1,000. So the price dropped to 3,960. So from here, you lost 1,000. Your cash balance was supposed to be 7,000. So you have the unrealized loss of 1,000. So day two, as you are holding one long FCPO contract, right? So the cash balance you have only 6,000. Okay, so from here, cash balance, maintenance margin. So you are less than the maintenance margin. So when you can understand when your equity is less than the initial margin, or you can call maintenance margin, you will receive margin call from the broker house, which means from us lah. You can understand that. So it is a 1,000 margin call from us. So from margin call, what you can do? How do you actually answer the margin call? Okay, the first one is the fastest way and the easier way to answer the margin call. One of it is the deposit the margin call amount. So you have the margin call of amount of 1,000. So if you deposit for 1,000, you can answer the margin call. Okay, another one is you have to make sure your cash balance have to become positive, which means more than 7,000 before market close if you want to hold your position. So assume that you only have 6,500 before market close. For that you have to close for before the market close because you don't have enough cash balance. Okay, moving forward, the third one is to close position. Okay, because you don't have enough cash balance to answer the margin call. So if you don't have and you don't close by, let's just say you are holding FCPO, the last time to trade is 6 o'clock. So 5:15, if broker check on your account, if you still don't close, broker will help you to force liquidate on the your position to answer the margin call, because it's to protect you from overloss as well. So that's how it works for margin call. Yeah, it's basically to help with the client not to lose, I would say not to lose a lot of money lah. Yeah. Okay, so moving on is the order type. So in futures, you have a few type of order type, just that I will just share 3 of it. One of it is order type, the basic one, which is market order. Buy, okay, you can understand market order is buy or sell at any current market best price. So basically you can long, and when you want to long is buy market, so you can refer to the current ask price. So if you enter with long, you are entering with 3,501, and for sell market, you are referring to the current bid price. So basically when you enter with long 3,501 and you entering with short 3,500, yeah, this is the, you need to know which one you want to buy and which one you want to sell. So okay, moving forward is the limit order. Okay, you can buy or sell at your designated price. Basically, which one is your more ideal situation that you want to enter lah. Okay, so assume today you expect market to decrease today. Okay, but you think current market price wasn't the best price to entry for now at 3,800. Okay, you think market will rise for another 50 points before decreasing. So you can place your sell limit at 3,850. So when market reached 3,850, your order will be executed, meaning the sell order will be executed on 3,850. So it's vice versa for buy limit as well. So you expect market to increase, but current price 3,800 wasn't the best ideal price for you to entry. So you predict it will drop for another 20 points. So yeah, 3,780. So you place a buy limit at 3,780, and when the market reach 3,780, so it will execute your order as well. So I think this is basically place the order at your ideal price lah, that you wanted the best entry for you lah. Okay, moving forward, we have this stop order. Basically, you can understand the stop order is to minimize your loss on either long or short market. So I just tell you on the first one first. If you are holding short market today, so the last done price is the one that you entry today, but you only can take up to 50 points of loss maximum today. So you can set a buy stop at 3,950. So when the market reach 3,950, you will directly close up your position, meaning you only lost 50 points from there. And vice versa as well, if you are holding a long position at 3,900, so which this one you already entry market, so but it's the same, you only can take up to 50 points of loss maximum. So you can set sell stop at 3,850, which is 50 points from your entry price. So when market reach 3,850, it will directly close up your position. Yeah, so that will be it for my sharing. So lastly, I would like to wrap up what my talk was all about. I've already concluded that the futures market trading advantages compared to other financial market, which are leverage, bi-directional trading, low transaction costs, and high liquidity. I have also included our famous local product specification of FKLI and FCPO. I hope that you all gain valuable insight on what I have delivered. I am really thankful that all of you take your precious time to join the webinar, and I hope you have a pleasant night ahead. So I will pass back to Shireen for the Q&A session. Shireen, are you there? Hello, Shireen. Just give me one moment.
Okay, so thank you, Jun Hang, for the sharing. So before we proceed to the Q&A section, so let me brief introduce on the account opening part. Okay, hold on. Okay, so we have successfully launched the first futures trading online account opening in Malaysia. So you can open a futures trading account online with no households. So if you wish to open the futures trading account online, so feel free to visit our website, or you can scan the QR code and it will directly link to the online account opening forms. So if you need guidance on online account opening form, please do not hesitate to contact us. So for free account opening, you will receive a complimentary mobile and desktop platform at no cost, and across access to wide variety of products, including global futures commodities, interest rate, indexes, and metals. So the platform for futures trading is FlipNova, which commonly used by our client to access global products. So for the desktop version, it's a web-based platform, but for the mobile version, you can trade using FlipNova applications, which allow you to trade anywhere and anytime. So you guys can scan on the QR code to know more. So next is the Phillip CFD Trader. So for this one is mainly to trade contract for difference, which is this is a leverage on stock. So this is the platforms. Well, last is our promotions. So currently we are having a promotion which is called as Trade Singapore Shares. So you can earn up to 200 ringgit of Aeon vouchers, and this promotion period is from 1st January until 29 February. So if you have interest, you can scan for QR code for more information. So next we will move to the Q&A sections. Okay, so Jun Hang, are you prepared? Okay, so first we will go to the first questions. So in order to trade FKLI and FCPO, may I know what is the initial margin?
Okay, yeah, okay. So for FKLI, it will be 4,000 per contract and 7,000 for FCPO per contract. Yeah, the initial margin.
Okay, so thank you for the questions. So next is the second question. So is okay. So can we trade further month for FCPO or FKLI contracts?
Yes, you can. For FCPO, you can track up to 36 months, and the spread of B and R will have a gap. It will be quite far. So the volume for further month will be much lesser, and the liquidity as well. If you wish to hold long term, it will be much better. For short or intraday trading, it's not suitable because you might not get your favorite price to exceed the market. So basically, you can trade further month for FCPO and FKLI as well.
Okay, noted. So thank you for the sharing. So next is okay, actually did Phillip offer 50% initial margin?
Actually, yes, you actually can trade with 50% margin, but you will need to fulfill certain requirement to trade with 50% margin. So if you want to know more, you can contact us directly. We will share the contact later. Thank you.
Okay, thank you. Okay, so there's one question which is I think I will answer for this. So is any idea for T+1 sections FCPO and FKLI why end at different times? So okay, actually for FCPO, right, the times is end more earlier compared with the FKLI. I think the most reason is because actually FCPO is quite volatile, and already a lot of the investor know this product and they will go and trade this product. But for FKLI is more different because as you guys compare, right, in BMD products, FCPO are more active compared with FKLI. So the reason why FKLI is end more 2 hours later than FCPO is because they want to attract more foreign investor to invest in FKLI. So that's why you can see actually the trading hour is quite later for FKLI. Yeah. Okay. So so let me see, is there any questions? Yeah. So if guys you have any question, you can just drop at the question box and we will answer accordingly. Okay. Okay. So okay, I think that's all for today. So if you guys have any inquiries, so please do not hesitate to contact us even through calls, email, website, live chat, or Facebook Messenger. So our representative will contact you as soon as possible. So if you guys have any question, can just contact us and we are very happy to assist you. So anyhow, thank you so much for participate on today's webinars, and thank you, Jun Hang, for the great presentation. So we will end our presentation here, and good night, everyone. Bye-bye.